Hi, this is Yanni from Stocks University. In this video, I will explain what time periods and time frames are in the context of technical charts. Let's start with time periods, as they are more familiar and are very common on most financial websites. For example, Google Finance, MSN Money, and Yahoo Finance. Simply put, the time period selectors on technical charts help you set the desired start and end date of the graphical data. Time periods are mostly used by stock traders for area and line charts. By default, most charts will have the one-day period selected, showing the most recent intraday price movement, covering the trading session between the opening bell and the closing bell. Usually, at the beginning of the trading session, the one-day time period will show only very little data. But as the hours go by, the chart builds up, so that by the end of the trading session, a complete representation of the price movement will be shown for that day. Other common time periods include 1 week, showing the price movement of the trading sessions in the last 5 or 7 days, 1 month, 3 months, 6 months, YTD, year to date, showing the price movement since the beginning of the year, 1 year, showing the price movement of the last 365 days, 5 years, 10 years, and all or max, showing the entire historical price movement that the website has to offer. As you can see, on Yahoo Finance, you can even select a specific time period by customizing the time range. Time frames, on the other hand, are used mostly with bar and candlestick charts to set the duration of each bar or candlestick rather than the time range of the entire chart. Choosing and analyzing multiple time frames is an important aspect of technical analysis. So while a chart of 1 day time period shows the trading session of only 1 day, a chart that uses the 1 day time frame can show a much longer time range depending on the chart's size and settings. Each 1 day bar or candlestick represent the opening, high, low, and closing prices of the trading session during that day. So in this chart, for example, the 1 day time frame is showing us about 9 months worth of data, but zooming in or out easily changes the time range to show a shorter or a longer time range. The 1 week time frame uses 1 week candlesticks, and the 1 month time frame uses 1 month candlesticks. A monthly candlestick represents the opening price at the beginning of the month, the highest and lowest prices during that month, and the closing price, which is the last price at which the stock traded at the end of the month. In charts where both time periods and time frames are used, you can see how the selection of a time period affects the setting of the time frame. For example, a 1 day time period sets an intraday time frame of anywhere between 1 and 15 minutes, depending on when the session has started. A 1 week time period sets in this example a time frame of 1 hour, while the all or maximum period sets the time frame to 1 month, that is, it uses monthly candlesticks. Note that changing the time frames does not have any effect on the time period. The reason is that in order to set a specific time period, one has to set not only the time frame, but also the size of the candles, so setting the time frame by itself is not sufficient. To summarize, time periods and time frames are basic elements in any chart reading and technical analysis. While time periods are usually used for general viewing of various time ranges, a wise selection and usage of specific time frames requires a deeper understanding of technical analysis. I hope you enjoyed this video. See you in the next one.